Welcome back, everybody, to another episode of Masters of Multifamily. I'm your host, Travis Watts, the Director of Investor Education here at Ashcroft Capital. Got a really exciting episode for you today. I've got with us Melanie, Sigma, and Byron McBroom. I'm going to let them introduce themselves in just a moment. But today what we're talking about is real estate and tax savings. Hopefully we'll hear some stories, perhaps some strategies that may help you. And a lot of this is going to be focused on the entrepreneur, the business owner, and of course, the real estate investors. So Melanie and Byron, a warm welcome to both of you. Thank you for joining us here today.
Thank you for having us.
You bet. So before we dive into it, and Melanie, we'll start with you. Do you mind giving our listeners just a quick background on yourself?
Yeah, of course. So my story is a little bit about my dad. My dad's been a CPA for 40 plus years, longer than I've been alive. And so I've heard all his knowledge throughout the growing up. I'd go on camping trips with him and his buddies who were, often entrepreneurs. And so I'd get to hear about all these cool strategies growing up. And so it's kind of led me down. I was actually the child that never thought I would be in the same field as my dad. And here I am.
As a tax and financial strategist today, correct?
Yes, exactly.
And Byron, the dad.
Yeah, I started my first practice in 1985 and basically just kind of bumbled and stumbled along. And the one habit I had that I'd highly recommend for everybody is I always did a lot of reading. So every lunch hour, I had my tax books, and RIA had a master's tax guide, and I'd read that. Pretty exciting reading, I know. But they always had tax tips where you just little tips. They'd talk about something, they have a tip. So over the years, I just accumulated tip after tip after tip after tip. And then what we've done is taken that and systemized it into, we have our 8-step process that we put people through. And it really just gives like people in my firm a step-by-step process that they can ask questions and be asking the question of somebody with 40 years of experience instead of 2 or 3 years of experience. So I always look for things that I can take and give to 100 people or 200 people. And what I found over the years is that most accountants are super hardworking people, but they're so busy filling out the forms, they don't take the time to come up with ideas for people. And this is probably the number one thing I get told that people aren't happy with their accountant for, is because they just fill out the forms and okay, see you next year. Yeah. So that's what we've really tried to do with this.
The proactiveness of it, I learned this lesson the hard way, like a lot of people years ago, just using a tax prep service. And when I vastly outgrew them and actually got a tax strategist myself, it made a world of difference. I mean, saved just thousands upon thousands. So let's dive into that. And let's talk on the topic of what I mentioned a few minutes ago. A lot of our investors being entrepreneurs, business owners, and investing with us here at Ashcroft and Multifamily Real Estate. So what should an entrepreneur or real estate investor be looking for in a tax professional if they're looking to make a change or just seeking somebody a little more advanced or as a strategist, let's say?
Yeah. So when we're meeting with people, we always say we like to be a profit center for them instead of a cost center. And so finding somebody that's going to be proactive for you. Everybody says they want a proactive tax professional, but what does that mean? It's somebody that is going to ask the questions for you, the questions that you don't really know what to ask, and ask the questions to save you money instead of filling out the forms. And so just finding somebody that's, has your back, asking the questions for you, because oftentimes taxes are almost like a foreign language. People don't really know what to look for, what to ask, what to think about. And so it's almost like they're a translator for you.
So it's very difficult for people that are so focused on their business or so focused on their investments and jobs. They just, they can't take the time to study it. It's just too much. So they just don't know what questions to ask. So you always want to watch what questions your person is asking you. If it's to fill out a form, you got the wrong guy. They got to do that sometimes. But if it's to probe on how I can save you some money, that's the one you want to look at.
That's great. Can you give us some examples of how you help real estate investors?
We've really systematized a lot of our strategies. We have what's called an 8-step tax solution that we've put together. Some of those are, getting your kids on the payroll. If you have kids under 18, getting them hired to the business. Like, for example, I have a 6 and an 8-year-old, and they're my little models for my business. And so I pay them, the IRS allows you to pay them $13,850 a piece tax-free. So I pay them that and then have them model for my business for marketing expenses. You can do that. You can rent your house to your business for 14 days tax-free with the Augusta strategy. And then a lot of what we do is looking at lower tax brackets around you and how can we shift income to those lower tax brackets and pay less taxes as a whole. So Dad, you should share about what you do with Grandma.
Okay. Yeah, my mom is 90 years old. Okay. And mom, they didn't save a lot of money. They wanted to retire quick, so they did. And then they had more month than money towards the end of it, like a lot of people do though. So I helped support my mom. So what I did is I formed a corporation. My mom owns it. She doesn't do any work. She just is the owner, passive owner. And then that corporation provides a service to my CPA firm. And then I have it make a profit of $84,000. That saves me. We're in California, so our taxes are higher than yours probably, but that saves me $41,000 a year. But my mom only has to pay $11,000 a year. So I take the money that I give her out of that, then she gives me the rest back as a gift every year. And so I give them, $1,500 a month changes my mom's life, but I get the credit for it while the IRS is paying for it. So it's kind of a neat little thing. But you can do this same plan with, we call it the baby mama plan. If you have kids in college, how to make college education deductible. We actually have a website, taxsavingsestimator.com, that you can actually log on, fill out about 3 or 4 minutes of questions, and it'll tell you what you're leaving on the table. So that's a real good tool for everybody out there, taxsavingsestimator.com. And like I said, it's free. And then you'll see how much money you're leaving on the table from a variety of strategies that we've already mentioned. So that's a really good one. But we talked about, how we save money for real estate investors. I'll tell you the story of, we'll call him Juan. He came to me about, I don't know, in 2010, I believe it was. And Juan was making about $1 million in his business, $2 million in his business, and he was going to owe a ton of money. He was just crushing it. And what we did for Juan is we did our kick the can plan. And what we do with that is we form a separate corporation most people have a December year end. Well, what we did is we formed a November year end for him for his payroll company. He paid all the payroll out through that. And then in the month of December, he would pay all the invoices. Well, since he paid it in December, it was deductible for his main company, but it wasn't taxable to the payroll company until the next year. Well, we basically, over a several year period, saved Juan the tax on $15 million using this plan. And starting in 2010, he plowed that $7.5 million of tax savings into real estate. Well, you can all imagine what having $7.5 million of cash to invest in real estate could do for you in 2010. He's a very wealthy man strictly because of the tax savings. I mean, he did a lot of other things right too, but just the tax savings, if he put it in at 2010 over a 5-year period, everything exploded during COVID. The guy's done exceptionally well, very, very well just on his tax savings. And that's what we like to do. We like to give you guys the option of either doing that or not.
Not just saving money too. We have a plan where we can do the plan that he was talking about, called our kick the can plan, where we show you how to funnel some money back and forth between 2 companies, one's with the fiscal year end. But we also have a reverse kick the can plan where we can increase your income so you can basically increase your capability of getting loans. And so it can not only help saving money on the tax side, but it also can help get you loans that you might not otherwise qualify for.
Prime examples of why to use tax strategist rather than just tax preparation services. I hope everyone's taken some notes here. So let's talk about, in that example with Juan, obviously a sophisticated, high net worth individual. Let's talk about what can a new investor do to capture as many tax deductions as possible?
I think the biggest thing that gets overlooked a lot, especially with taxes and tax strategizing, is just having a good set of books. A lot of people bypass that, but then they come to us a few years later and their books are a hot mess and it's really expensive, time consuming. and a big headache to clean up. So I'd say the biggest thing for new investors is making sure you have some sort of bookkeeping system with an automatized software that basically just systematizes the process. You have a separate bank account, separate credit cards for all your business transactions, and just make sure you're tracking it from the get-go, just to keep things, because you can't tax plan if you don't have a clean set of books, but you also don't know, just for business purposes, for growth and all of that, you can't do that without knowing what your numbers are.
What's key on that is to have a dedicated credit card and a dedicated bank account. Because then as you're doing something, if you're spending the money and it's regarding a business thing, you use those accounts. Because then once you throw it all into QuickBooks and stuff, you're going to get every deduction possible. Where if you're commingling everything, then you have to go through and say, is that business or personal? And you just don't remember. So as you're doing it, I always say write on the receipt, then use with QuickBooks. I know they have a picture taking receipt capture. You just take a picture of it and it gets embedded into your QuickBooks. Then you don't even have to save the receipts.
100%. So I want to switch gears just for a minute. Here at Ashcroft, we do cost segregation studies on all of our properties. Can you explain what cost seg is, or how investors are able to take advantage of that depreciation?
Okay, so what happens when you normally buy, let's say, an apartment complex, or let's say we're looking at a mini storage place or a commercial strip or something like that. Most of the stuff is going to be depreciated on a long period of time, either 27 and a half years for residential real estate, might be 31 years, it might be up to 39 years. So when you do a cost seg study, what it does, it breaks everything out to 5-year property, 7-year property, 10-year, 15-year, 20-year, 27.5-year, 31-year, but it breaks it all out, and you can take that depreciation a lot faster. Well, the beautiful thing about a cost seg study, and currently we have a thing called bonus depreciation. Well, with bonus depreciation, anything that's under a 20-year life, if for the 2023, you can take 80% of that in year one. One more thing on the cost seg, with a bonus depreciation, you can take 80%, but you also have available Section 179 for the shorter year lives that you can take using 179 and take up to the 20-year life on the bonus. So you still, in theory, you could still get 100% of it this year. It just won't come all in bonus depreciation. Some of it might come in a cost in the Section 179.
That's a great point. I appreciate you adding that. So with real estate professionals, I get this question a lot. And of course, we're not, tax advisors or experts in this area, but we were talking a little bit before the call about this. So can you explain real estate professional as it pertains to the eyes of the IRS, what that means and who might potentially be able to qualify for that?
Yeah, it's hours based. So it's 750 hours. And what that means is that you can turn your passive income into active income. So this is really great, especially if you have a high W-2 earning spouse and you're a real estate professional. It doesn't mean that you have, your real estate license. It just means that you work 750 hours in some form of real estate. And so we actually have a flow chart. We can send that out. And, if you text the number 209-924-4192, we could text that out to you, but there's just a lot of qualifying activities that can qualify you as a real estate professional. But like I was saying, this is really great for those of you that have a high W-2 income earning spouse. You have a real estate portfolio. You can offset a lot of that W-2 with your real estate portfolio. Dad, you can add to that too.
The only other thing is on most of your properties, they're not self-managed because they're managed professionally.
Right.
But on some properties, if you self-manage them for at least the first year, that allows you to be more of a professional, and then you can take the bonus and then convert it to management. That's just a little tip for it. It won't be most of the things you do with Ashcroft wouldn't be that, but
Right.
for like an Airbnb or something like that, that might be something you might want to consider.
Sure.
Because a lot of investors are high W-2, and it's sad, but there's just not much you can do for them. Well, by qualifying as a real estate professional, you can offset a lot of your income. That's a very, very good tool to use.
Another thing to add too is you can also buy into syndications and use those losses to offset your active income as well as a real estate professional.
Key point. Yeah. And a lot of our investors do have their own individual properties as well. For many people, a syndication is just a form of diversification for them from the stock market or their individual holdings. So that's great info. So let's talk a little bit about holding companies. Another common question we get, you hear it at conferences and through podcasts, people talking about maybe Nevada, Wyoming, tax-free states. So let's talk about that. Should someone have a holding entity? What are the advantages or disadvantages? What about those states? Anything you want to add to that topic?
From a tax perspective, there's not a lot of advantage. You have to be, you're taxed in the state that you live in. And so even if you form a Nevada company, you're not going to be taxed. Your income's going to go to, let's say I live in California. So if I had a Nevada company, I'd still have to pay California tax, unfortunately. But from a liability perspective, it might be beneficial. And that's where you just refer to an attorney for that. It just kind of depends on what state you're in. But we find, a lot of people come to us with just thousands of entities. And sometimes it makes sense, but sometimes it doesn't. Sometimes it's easier just to keep it simple.
What type of entities do you typically see, for limited partners? They're doing syndications, things like that. Is it a disregarded entity, single member LLC? What else do you see out there?
Normally, if you're gonna be invested in a syndication, their syndication is going to be a protected entity. Okay, right. So you don't have to have an LLC own an LLC to have any extra protection. Usually, if you're flipping properties, we like to see it in an S corporation, assuming you're making over 50, 60, 70. If you're buying and holding, we like to see it in an LLC. A normal business is probably going to be an S corporation. There are some different circumstances where you might want to be a C corporation, but when I've run the numbers, most of the time it's an S corporation.
Case by case situation, it just depends, but that's kind of our blanket rules.
Yeah. So what are some ways investors can potentially avoid capital gains? Usually we're selling these properties usually between 3 to 5 years on average, or historically speaking. So assuming there's a profit there, we offer investors the ability to 1031 exchange with us if they wish to do so. Never promise guarantee. We have to obviously have a property that makes sense that we can do that with. But what else? What else could we talk about on capital gains?
Yeah, we have a few options that we like to call our hangover pills. They're your cure to the pain of capital gains, and they're good for anything above 200 to 250,000 in gains. So those are going to be the bigger gains, a highly appreciated asset. Before the listing, you have a charitable LLC option. During the sale, we have an installment sale or a deferred escrow trust. And then after the sale, you have a charitable lead trust. They're kind of complicated, actually very complicated. So going into detail might bore you guys. So I won't do that, but there are definitely options. Dad, anything else you can think of?
Well, I just wanted to give an example of what we did with the charitable LLC.
Yeah, that's a good idea.
So I had a client who was selling his business for $6 million. He had almost no basis in it. So it was all gain. It was in California, and he was going to have $2.2 million in tax. Okay. So with a charitable LLC, what we did is we formed an LLC. We made it a 1% manager, a 99% member. In his particular example, we put 40% of the business into the LLC. And before the sale, before everything happened, we donated that 99% interest of the LLC to a 501c3. So what that does is two things. One, 501c3s don't pay capital gains tax or pay tax on interest or dividends. So now his capital gains, instead of being $6 million from the sale, was only $3.6 million. In addition, he got a deduction for the fair market value of that 99%. So he got almost a $2.4 million tax deduction to offset the 3.6. And so the capital gains is only taxed at capital gains rates, but the charitable deduction was at ordinary income rates. So his tax reduced from $2.2 million down to $128,000 with his strategy. And usually what we do is we'll pair that with a life policy, because we put $2.4 million of value into that LLC, and upon the guy's death, it goes to a charity. But basically what we did is we just had him prepay for a $2.4 million policy out of the tax savings, and his family got the same amount of money. And the beautiful thing is that money sits in the piggy bank of the LLC till he passes away, and he can use that money to buy new projects. So he doesn't have to worry about identifying a property in 45 days and closing within 180 days. You lose some of those things. You have, let's say, Travis, you didn't have a property available for people. This would be a great alternative to get beyond the 45 days for identification, or 180 days, so then they could reinvest and not have the issues. So basically the LLC would just loan them back the money, secured by the asset, and then they would invest in you again and be able, instead of, the thing about 1031 is you transfer over the basis. By doing the charitable LLC, you get a new high basis to redepreciate.
That's incredible. So let's stay on this topic of unique strategies. This is fascinating to me. So a lot of our clients use self-directed IRAs. Any thoughts you want to share on that, or any creative strategies you've done with self-directed IRAs when it comes to real estate or anything else for that matter?
I want to go back for a second and touch on the capital gains. One strategy that's very good and not very, exciting is death. Is if you have properties, you can put those properties, gift those to your parents if you have parents that are at the end of their rope, or that might be a good option, is to give them the properties and then you inherit it upon their death and you get a step up in basis. That's actually not a fun strategy to think about, but it can save a ton of money if you have a lot of properties over the course of, X amount of years. So
we had a client who, he's a wholesaler. He's just exceptionally good at finding properties, and he finds them to the tune, and he makes about 25,000 a property. He just flips them over to a flipper and he gets a $25,000 deal. Doesn't even take title to it. He just ties the property up. Well, what he did is he formed a Roth IRA and he ties up the property with his Roth, and then he flips it to the guy who makes $25,000 a pop. Well, you can make, if you just do 5 transactions, you're not going to be considered a dealer. So he has a Roth, his wife has a Roth, he has 2 kids, they both have a Roth. So he can do 20 transactions a year with a Roth IRA, and he's never going to pay tax on the money. So I just thought that was clever as heck on his part.
So if our listeners want to take this a step further, if they want to learn more, what do you guys have to offer? How do they find you? Website, phone number, what's best?
We have, actually, if you're on Instagram, I post a lot on Instagram. Melanie Sigma is my handle. And then One Stop Tax Strategists, we post every day. I often link them together. So you follow one or the other, you'll get a lot of good information there. I try to post at least once or twice a day, tax tips that are helpful for our followers. We'll put in the notes, we can put our link tree. That's a way that we can offer you a free tax assessment. It's just a 20-30 minute call where I'll ask you several different questions just to uncover savings of anything in this area. And then my dad, and that'll also have the self-assessment tool on there as well. So you can kind of pick the road that most attracts you.
Thank you for extending that here for our listeners. And investors, stay tuned for more upcoming episodes here on Masters of Multifamily. If you ever want to learn more on Ashcroft Capital or our current offerings and opportunities, you can reach out to myself, Travis, at ashcroftcapital.com, or you can visit avaf3.com. Have a great week. Thank you again, Melanie and Byram, and we'll see you guys on the next episode.